I am joined by Justin Smith, Head of Research at Extract Research. Glad to have you here, Justin.
Thanks for having me.
Justin, before the pullback in the primary market, we've seen a supply and demand imbalance in the market where borrowers had a lot of pricing power. They were pushing for tighter pricing, for less covenants. Do you think that this trend will continue once we see a pickup in the primary market?
Sure. I mean, I think we've seen the tide turn a bit even in the last few months with a little bit more balance in terms of supply-demand, and that has translated into lenders being able to push back a bit on covenant packages. We saw this in a recent credit agreement that the draft had a fairly aggressive term, a pre-cap provision, which was then taken out in the final credit agreement.
Was it the American Airlines? Or
It wasn't. It wasn't. I forget the exact name. But yeah, so we're seeing that across the board in terms of credit agreements and also high-yield bond indentures. And so the terms that are more aggressive that sponsors could once get 6 months ago are now, because of the balance in terms of the supply-demand, are now being questioned more by the lenders.
Interesting. And at Extract, you analyze on a daily basis and you parse through all these covenants in bond indentures, in credit agreements.
Sure.
Is there a trend that you see this year related to these covenants, or maybe we can say the lack of them?
Yeah. Well, I mean, the long-term trend over the last few years has been lack of maintenance covenants. And so when we talk about Cov Light, I think it's important to take a step back and figure out what we're talking about. The lack of maintenance covenants in the larger leverage loans, I think, has been a mainstay and is probably here to stay. So the question mark becomes, in the middle market, do those maintenance covenants come back once there's more of a balance in terms of supply-demand? And then, digging into the details of the covenant packages in terms of how much flexibility borrowers get. And I think what we've seen over the last year or so on the credit agreement side is more credit agreements tending to look more like high-yield bond indentures. High-yield bond indentures are more flexible, so more flexibility. And then it's really just a matter of where the limit is and how much flexibility lenders want to give. And so, like I said, I think a few months ago, 3-4 months ago, we saw deals getting done with very aggressive terms, and I think that's changed a little bit. So I think in terms of the market, it's become a little bit more healthier, at least from a document perspective, in terms of what lenders can push back on and how much leverage they have.
And you mentioned covenant light deals, and we know that we've seen that they've surpassed, I think, 50% of the leverage loan issuances this year. Yep. And some investors are concerned that these covenant light deals are risky, and they point to the risky practices of 2007 that preceded the recession. But there is another school of thought, and some people are saying, well, let's start looking at these deals and looking at the metrics, leverage, ratings, the use of proceeds, which a lot of times is to refinance debt. Mm-hmm. And when you look at these metrics, you see that these deals are not that risky. Maybe they look like 2005 deals, where the risk of new issue was moderate. Mm-hmm. What do you think? In which camp do you situate yourself? Do you find yourself?
Hard to say. I think with covenant-like deals exceeding 50%, I think there's no question that a good chunk of the market has sort of accepted the lack of maintenance covenants, and I think that's certainly the case for the larger leverage loans when we're talking about over $500 million. But then when we start to go down into the larger middle market, or even the smaller middle market between 100 and 500 million, that's where the question marks, I think, arise. And I think if you look at the last down cycle, there has been research that has shown, at least in terms of the better credit qualities, that the lack of maintenance covenants didn't affect the recovery values. And so at some level, it's okay. I think it's just a matter of where you draw that line. From a lawyer's perspective, it's hard for me to say exactly where the right line is to draw. But we've certainly seen over the last year that creep into the middle market, the lack of maintenance covenants.
Thank you so much.